February 2nd, 2026, 10 o'clock in the morning, Eastern Standard Time. Most silver investors are sipping coffee, scrolling through charts, waiting for another routine Monday. They have no idea what's about to hit them. They think Monday is just another trading day. They think the worst is behind them after that brutal 30% crash 4 days ago. They're wrong. Monday isn't just another day. Monday is a liquidation event. The ledger doesn't care about your hope. The ledger only cares about settlement. And on Monday, everything settles at once. We've been taught to think about silver as a simple commodity, supply and demand, industrial usage, inflation hedge. But that's the surface story. Beneath every price movement, beneath every rally and crash, there's a darker machinery at work. It's the machinery of leverage, margin calls, and forced liquidation. It's the machinery of global capital flows, central bank positioning, and institutional panic. Silver doesn't move because miners dig more or less. Silver moves because someone, somewhere, is going bankrupt. And when they go bankrupt, they sell everything. Monday is when the bills come due. Let me take you back just 1 week, January 30th, 2026. Silver was trading at $121 per ounce. It was glorious. Retail investors were posting screenshots of their accounts with six-figure gains. Financial pundits were calling it the new gold rush. YouTube thumbnails screamed about silver going to $200, $300, even $500. The euphoria was intoxicating. But euphoria is expensive, and someone was about to get the bill. Within a single trading session, silver collapsed from $121 to $78. 30%. Gone. Evaporated. That's not a correction. That's a margin call apocalypse. Leveraged funds that were riding high got obliterated. Futures contracts that seemed safe in the morning were underwater by lunch. Stop losses triggered in cascades. Each sale triggered another sale. Each liquidation forced another liquidation. It was a mechanical slaughter. No mercy, no pause. Just the cold mathematics of forced selling. But here's what most people missed. That crash wasn't the end. It was the setup. Think of it like an avalanche. The first rumble isn't the disaster. The first rumble is the warning that the entire mountain is unstable. And now, 6 days later, the mountain is still shaking. The leverage is still unwinding. The fear is still fresh. The positioning is still broken. And on Monday, we're going to find out if the mountain holds or if the whole thing comes down. India gave us the first clue. While American traders slept through the weekend, India's silver market detonated. February 1st, 2026. The MCX silver futures market in Mumbai opened and immediately plunged. Prices dropped from 337,000 rupees per kilogram to 291,000 rupees. That's roughly $97 per ounce in equivalent terms. An 11 to 15% crash in a single session. Chennai saw 85,000 rupees per kilogram wiped out. Delhi, Kolkata, Mumbai, every major hub, uniform carnage. Why does India matter? Because India is one of the largest physical silver markets on the planet. When Indian buyers panic, it's not just a local problem. It's a global contagion signal. Indian traders were taking profits after silver briefly touched all-time rupee highs just 3 days earlier. They were spooked by hawkish signals from the Federal Reserve. They were cautious ahead of India's union budget presentation. Fear plus greed plus uncertainty. That's the formula for collapse. And the collapse happened over the weekend when most of the world wasn't watching. This is the backdrop for Monday. Asian markets trade before America wakes up. The COMEX silver futures market opens at 6 p.m. Eastern on Sunday evening. That's when Shanghai, Hong Kong, Tokyo, and Mumbai start pricing in the weekend chaos. If the selling spreads from India into China and Japan, the U.S. market will gap down violently when New York opens Monday morning. You could wake up to silver at $80, or $75, or lower. The gap could blow through every stop loss you carefully placed on Friday afternoon. But the real danger isn't the overnight gap. The real danger is what happens at 10 a.m. Eastern on Monday. That's when the ISM Manufacturing Purchasing Managers Index drops. This isn't just another economic report. This is a binary event, a coin flip that will move silver 5 to 10% in either direction within minutes. The ISM measures manufacturing activity across the United States. A reading above 50 means expansion. Below 50 means contraction. The consensus estimate is hovering near 49.5 to 50.5, right on the knife's edge. Here's why this number is a loaded gun. The ISM directly impacts Federal Reserve policy expectations. Strong manufacturing data means the economy is resilient. That supports a stronger dollar and hawkish Fed policy. Weak manufacturing data means the economy is fragile. That supports rate cuts and a weaker dollar. Silver crashed last week when the dollar strengthened on hawkish Fed signals. If Monday's ISM comes in strong, the dollar could surge again, and silver could collapse. If the ISM comes in weak, the dollar could crater, and silver could rocket. December's ISM reading was 49.3. Manufacturing in contraction. If Monday's number comes in at 52 or higher, that's a shockingly strong reversal. Markets will price in Fed hawkishness, dollar strength, commodity weakness. Silver gets crushed. If the number comes in at 47 or lower, that's deepening contraction. Markets will price in Fed dovishness, dollar weakness, commodity strength. Silver explodes higher. The swing potential is massive, and it all happens at 10 a.m. Now layer in the technical positioning. Silver closed Friday around $85 to $86 per ounce. That's not a random price. That's a critical support zone where previous rallies have either accelerated or died. Major moving averages are converging near this level. The 50-day, the 100-day, the 200-day. When these averages cluster together, they create a magnet effect. Price consolidates, tension builds, and then something breaks. Either support holds and we launch higher, or support fails and we collapse lower. Monday will decide. The commitment of traders' data adds another layer of danger. Before the January crash, commercial shorts were heavily positioned against silver. These are the banks and institutions. They were betting against the rally. Managed money, which is mostly hedge funds, were heavily long. They were betting on the rally continuing. When silver crashed from 121 to 78, those long positions got liquidated, violently. But we don't have full transparency on current positioning yet. The next COT report doesn't drop until Friday, February 7th. What we do know is that leverage traders are terrified. Stop losses are tighter than they've ever been. Position sizes are smaller. Conviction is shaken. This creates a hair-trigger environment. Small moves cascade into large moves. Tight stops get triggered in both directions. It's a feedback loop of fear. And when fear is this concentrated, it only takes a spark to ignite a wildfire. Monday's ISM data is that spark. Here's the contradiction that should terrify you. Despite the paper price crashing from 121 to 78, physical silver premiums never collapsed. Dealers are still charging $6 to $8 over spot for silver eagles. Generic rounds are $3 to $4 over spot. This tells us that physical demand didn't evaporate. Industrial users are still buying. Retail stackers are still accumulating. Smart money is still adding on the dip. There's a divergence between paper and physical, and divergences don't last forever. They resolve violently. If premiums stay elevated or widen on Monday despite weak paper prices, that's a signal of extreme market stress. It means the physical market doesn't believe the paper price. It means a squeeze is building. If premiums compress, it means the physical market agrees with the paper sell-off. It means the crash is real and justified. Watch the premiums. They'll tell you the truth before the charts do. Let me walk you through the historical parallels. March 2020. COVID Monday, March 16th, 2020. Silver gapped down violently as pandemic panic hit. Asian markets had crashed overnight. The gap was brutal. Those who panicked and sold at the Monday open locked in the worst prices of the decade. But Monday also marked the bottom. Those who held or bought the panic saw silver more than double over the following months, from $12 to $30. That Monday felt like the end of the world. It was actually one of the greatest buying opportunities in modern history. May 2011, the $50 rejection Monday. May 2nd, 2011, silver opened lower following its rejection at $49.82. Asian markets had been selling. The Monday gap triggered stops. Prices cascaded lower throughout the day. That Monday marked the beginning of a multi-year bear market. Silver didn't sustainably break above 25 again until 2020, nearly a decade later. That Monday wasn't a buying opportunity. It was the start of prolonged suffering. August 2020, the $30 test Monday, August 17th, 2020. Silver tested the $30 level after a massive rally from 12. Asian markets were mixed. The Monday action was choppy and violent. Silver corrected 15% over the following days. But the trend remained intact. The Monday volatility was just a shakeout before the next leg higher. Not every Monday is decisive, but every Monday reveals information. The question for February 2nd is simple. Which historical parallel are we following? Are we following March 2020, where Monday marks the bottom and the start of recovery? Are we following May 2011, where Monday marks the start of prolonged decline? Are we following August 2020, where Monday is just violent chop within an ongoing trend? Monday's ISM data and price action will provide critical clues. But you won't get the answer by watching passively. You need to understand what to watch and when to watch it. Sunday evening, 6 p.m. Eastern. That's when Asia opens. COMEX silver futures resume trading. This is the first signal. Does silver gap up or down from Friday's 85 to 86 close? What's the volume on the initial move? Are Asian markets like Shanghai Gold and Hong Kong showing strength or weakness? If silver gaps down to 82 or below in heavy volume, scenario 2 becomes more likely. That's the collapse scenario. If silver holds 85 or gaps higher with Asian buying, scenario 1 becomes more likely. That's the recovery scenario. Between Sunday evening and Monday morning, watch the overnight trend development. Is the gap filling or extending? Are physical dealers reporting unusual demand or unusual selling? What are gold and the dollar doing? Any breaking news overnight that could impact Monday's action? The overnight session is when the smart money moves while retail sleeps. They're repositioning. They're front-running the ISM data. They know something you don't, or they think they do. Monday morning, 9:30 a.m. Eastern. U.S. equity markets open. Watch the correlation. Do stocks open strong or weak? Risk on or risk off? Is the dollar moving significantly? Does silver experience a surge of volume at the equity open? Are mining stocks gapping up or down, and by how much relative to silver? The equity market open often brings a volume surge that can confirm or reverse the overnight move. This is where retail enters the game. And retail is emotional. Retail chases. Retail panics. 9:50 a.m. Eastern, 10 minutes before the ISM release. This is pre-positioning. Watch how silver behaves in these final minutes. Is it consolidating, rising, or falling into the data? What's happening in silver options? Implied volatility should be spiking. Traders are hedging. Traders are speculating. The market is coiling. How the market positions into the data release tells you what the big players expect. Are they leaning bullish, bearish, or neutral and terrified? 10 a.m. Eastern. The ISM Manufacturing PMI releases. This is the moment. Algorithms will trade instantly. Within milliseconds, the number hits the wire and orders flood the market. Humans follow within seconds. The first 60 seconds after the data drops will be critical. Watch the headline PMI number versus the consensus. Watch the subcomponents, new orders, employment, prices paid. These details matter, but the instant price reaction matters more. Is silver spiking, crashing, chopping violently with no clear direction? 10 to 10:30 a.m. Eastern, post-ISM price action. The initial move is often a head fake. The real move happens in the 30 minutes after the data. Does the spike extend or reverse? Is there follow-through, buying or selling? Are physical premiums moving in correlation with paper prices? What's the volume profile? High volume confirms the move. Low volume suggests the move is fragile and could reverse. This half hour will determine whether the ISM reaction was real or just algorithmic noise. By Monday's close, You'll have critical information. Did Monday confirm a scenario or leave us uncertain? Is Friday's jobs report now even more critical? Has the technical picture clarified or become more muddled? What's the next high-probability setup? Monday won't answer every question, but it will narrow the possibilities. It will eliminate some scenarios and elevate others. Information is advantage, and Monday delivers information. Let's talk about the psychological challenge. If you held through the January 30th crash, you're traumatized. You watched 30% of your position value disappear in one day. That was 4 days ago. The wound is fresh. Your confidence is shaken. Your conviction is being tested. Now you have to face Monday. And Monday could do it again. Or Monday could rally and make you wish you'd bought more at the lows. Either outcome is psychologically brutal. If you sold during the crash, you're dealing with regret and hope. You panic sold somewhere between 78 and 90. Now silver is around 85. You might have sold near the bottom. You're hoping for another crash to get back in lower. But you're also terrified that Monday triggers a recovery rally that leaves you behind. You're paralyzed. You can't win. If you buy back now and it crashes, you're stupid. If you wait and it rallies, you're stupid. The mind games are endless. If you bought the dip, you're on edge. You thought you were getting a great deal at 80 to 85 after the crash from 121. Now you're not sure. If silver drops more on Monday, you'll feel foolish. If it rallies, you'll feel vindicated. But the uncertainty is agonizing. You're checking the price every hour. You're refreshing charts. You're reading every tweet, every article, every comment. You're looking for confirmation bias. You're looking for someone to tell you that you're right. Here's the truth. Whatever you feel Monday morning is probably pushing you toward the wrong decision. Fear makes you sell at bottoms. Greed makes you buy at tops. Regret makes you chase moves that already happened. Euphoria makes you overextend into moves that are about to reverse. The market is designed to transfer wealth from the emotional to the rational, from the impulsive to the disciplined, from the reactive to the prepared. Which side will you be on? Make your decisions before Monday's Asia Open. Decide now what you'll do if silver gaps down to 80. Decide now what you'll do if ISM comes in at 47 or 52. Decide now at what price you add, at what price you hold, at what price you exit. Write it down. Create a battle plan. Then when Monday's emotions hit, you follow your pre-made plan instead of your real-time feelings. This is harder than it sounds, but it's the only way to survive volatility without destroying yourself. Let me give you specific warnings. Warning 1. Do not trust the first move. The Asia Sunday evening gap could be violent in either direction, but that gap might hold or it might get completely filled and reversed by Monday's close. Don't react impulsively. Let the day develop. Wait for the ISM data. Let the full picture emerge. Warning 2. The ISM data could surprise in either direction. Consensus is 49 to 50, but manufacturing data has been volatile. A surprise to 47 or 52 would shock markets and trigger violent moves. Be prepared for the unexpected. Warning 3. Physical versus paper divergence could widen dramatically. If paper crashes on Monday but physical premiums spike to $15 or $20 over spot, something's broken. This has happened before during major dislocations. Watch dealer pricing. If premiums explode while paper collapses, it signals either an incredible opportunity or systemic failure. Warning 4. Monday sets up the rest of the week. Whatever happens Monday determines whether Friday's jobs report becomes even more critical or less important. If Monday is decisive, Friday confirms or reverses. If Monday is inconclusive, Friday becomes the next decision point. Warning 5. One day does not make a trend. Even if Monday is huge in either direction, it's still just one day. Trends take time to develop. Monday's price action needs confirmation from subsequent days. Don't overreact to a single day's move. Wait for follow-through before making major portfolio changes. This is discipline. This is survival. This is how you avoid becoming the liquidity that smart money feeds on. Most investors will react too late. They'll read headlines explaining moves that already happened. You don't have to be one of them. Review your exposure. Know your exits. Know your ads. Have a plan for up or down. This isn't fear-mongering. It's pattern recognition. Multiple forces are converging, and Monday is the pressure point. The market rewards preparation, not hope. Monday is a settlement day. Margin requirements reset. Brokers make calls. If collateral isn't posted, positions are liquidated at market. No discretion, no mercy. That's the machinery beneath the surface, and that's why Monday matters. Markets don't move on opinions. They move on deadlines. We just saw panic in India, double-digit losses in a single session. That fear doesn't stay local. It travels across time zones. By the time you wake up Monday, the damage may already be done. Most investors will react too late. They'll read headlines explaining moves that already happened. You don't have to be one of them. Review your exposure. Know your exits. Know your ads. Have a plan for up or down. This isn't fear-mongering. It's pattern recognition. Multiple forces are converging, and Monday is the pressure point. The market rewards preparation, not hope.